Mean reversion is often considered one of the most powerful trading and investing ideas, but it hasn't been happening on the most popular stocks in 2023. Why is that? Well, today we take a look at the data behind what's driving these markets up more bullish than ever before. We'll also be talking about CPI inflation numbers, the FOMC, and to top it all off, the trillions of dollars into what we call quadruple witching events. Yes, there's a ton of options expiration coming, and this remains the most hedged event of 2023 so far. So let's take a look at everything to do with stocks, commodities, and cryptos right now in these markets. Well, welcome back everyone to the Daily Show where we talk about markets around the world. We've got the latest macro, leading news, indicators, and of course, hottest charts coming your way. If it's your first time here to the channel, welcome to the community. Subscribe and smash that like button if you find value in today's video. I'm sure you will. Tesla stock rises again. Yes, it's on its run. We've talked about the zero DTEs, and it seems like they're starting to lose a little bit of steam, but we still have some big levels moving forward. Of course, I thought 230 might be the high, but 260 is also a gap fill. And over the next 24 hours, I'm pretty sure we're going to start seeing the real storyline of that stock playing out. Now let's move over to some interesting data points that we've seen recently. Now we talked about mean reversion at the beginning of this video. What about the S&P 500 away from its 50-day moving average spread? Now, this is unusual. We've seen an extreme overbought condition that's shown up for 5 straight days on the S&P 500. This is closing 2 standard deviations above the 50 DMA. Look at the other times that this has happened over the last 12 months. Usually it hasn't been able to stay above for over 3 days. Coincidence? Well, let's have a look at some of the evidence building on the data points. Do we have a technical turn? No. Do we have reasons to potentially build evidence towards this being an extremely dangerous level to enter into huge positions? I would say yes. Here are the net calls. We can see again some of the data points. I put this in the weekend video. Look at this over 2 years of data. Some massive calls coming into the markets. We know, of course, this has been one of the biggest tech equity flow inflows for a while. Pings are heating up in the market. I shared that over on our Twitter at FX Evolution. Links in the description down below if you're interested in following. Here's another one. CBOE equity call options over 1 standard deviation away. And you can see here the periods of time over the last 12 months plus that we've had these types of reads. And in general, markets have dipped lower over the next coming weeks. Remember, we kind of said on the weekend video that I expect usually with these types of reads to see a technical sell within 1 to 2 weeks. Have we got one yet? No. Are we heading into another big level? Yes, and we'll show you that a little bit later on. And if you're trading individual stocks and trading sectors and you're going bullish, hey, there's nothing wrong with that. Of course, there are very, very good stocks that are moving at the moment to the bullish side, and you rightfully so jumping into that trend. But you've just got to be cautious here, and there are some reasons why. We know, of course, trillions of dollars are expiring this week. Here are the pre and post week over the last kind of like 20 plus years. And you'll notice that actually over the last 2 years, the pre-week, which is the week we're in right now, have been negative by the end of the week. Now, of course, after the Monday trade action, they are not negative, but as we know, things can change a lot with CPI numbers, possibly the most important bit of information of the month. One thing I noted here, and I think it's maybe worthwhile keeping in the back of your mind in the future, is if you see a technical sell reason in post-OPEX weeks, that is after the September option expiration, only 7 were bullish and 23 were shorts. That's over 30 years there. That is an incredible data stat. Just a quick reminder as well that you should be thinking about the structure of the markets right now. So of course, we know this is the most hedged event. It's hard for the markets to sell off too much this week. And even if they do sell off, they're only going to be able to get down to, let's call it max pain style levels, at least in general. Why? Because if you see here the volume structure, this is actually where all of the hedging goes on. The CPI, the day after, which is the FOMC, and then, of course, the 3rd week OPEX options expiration, those trillions of dollars coming in. Fear and greed index, well, there's no doubt that it's in extreme greed now, and everyone's feeling like new highs are inbound, the market's never going to stop. It's the same old story that usually happens. But again, if you're following the trend, have you seen a change? Not yet. So that's, I think, very important. What about the surveys coming through? Well, this one absolutely floored me last week. I was guessing 33% of people would be bullish. 44.5% of people answered they would be bullish over the next 6 months. That's an incredible read. Usually times that we've seen this, again, 1 to 2 weeks later, we've usually had a significant swing trade style short. And the thing that kind of gets me a little bit more excited is with this evidence, if you are actually looking for those types of things, and a lot of people would say, well, yeah, well, what about 4,200? Well, we never had these types of reasons, that's for sure. But if you get them, you're actually often instigating a swing trend. And that swing trend could go for mean reversion, which is, of course, a very important point. Now, could markets keep going? Absolutely. You've heard probably the statement of markets can remain irrational longer than you can remain solvent. For many people, that's probably already true. The markets have remained incredibly irrational to them. And ever since probably more like a 4150, 4200, it hasn't made sense. Well, we've moved to the next level of equilibrium and then some on the stock markets. And unfortunately, there could be a little bit more to go before you even hit the next technical resistances. And we'll talk about that later. Here's another one when we talk about the AAII bull bear spread. Here are some of the points where you've noticed in the past we get a little bit too exuberant. And you know, it's uncanny in markets. It's just like Warren Buffett says, when people are greedy, you should remain fearful, etc., etc. In this case, the greed is real. And you can see it's actually the second biggest record in over 10 years in terms of how hyped people are in this market. Now, we know that we exited a technical bear market last week, and that is where we go from basically the bottom up on the S&P over 20%. And we also know that we can draw stats from that. In fact, the next 3 weeks were historically negative towards markets, and it's something that I think we should keep in point here when we're looking at these markets. Is it time to be a little bit fearful? I would say it's time to be very cautious with your portfolios and the way that you're looking at things. But hey, you could have argued that for the last 100 points on the S&P for sure. And it's all about being able to see the turn. And as an investor, you probably don't care. You're just like, let this thing keep going up. It's all good with me. I just want to make some money, man. Absolutely. Let's move over to the interest rates. Now, they've gone back to where they were in February pretty much, which is higher for longer and less chances of rate cuts. The FOMC should strengthen this case. I would say the FOMC should not be looking at rate cuts anytime soon. And they keep saying that they're not rate cutting to 2024 at a minimum. So the market's disagreeing with that. Well, the Fed's lied to us most of the time. So in this case, I believe the Fed has to keep rates higher for longer. I've argued that for a long time. So far, we've been correct. We'll figure out whether that happens or not. But again, is it even giving us edge in this market right now? Probably not. And I think that's something important. Let's have a look here at forward PE. As we know, it's a bit expensive. It's not super expensive. So some mutual funds and investors would just be looking at the 10-year averages and saying, well, it's not too bad. I think it's okay to invest in. For me, I always like to look at least under 16.8. And ideally, I like those kind of high 15s, 15.5. If you can get one of those for a forward PE with a high VIX, let's just say it's a pretty good level. Is the market acting like every other pre-election year? Well, the answer is simply yes. It's running in June, which is technically what usually happens. Technology leads into the July period, and then we get the bad Q3. Now, Q3 tends to be one of the worst periods of the year for markets, and it's, again, an earlier Q3 sell-off that tends to happen in pre-election years. If this trend continues to be correct, we're basically here right now, so we've got a little bit more, and then we might see a nice stabilization sell to get us mean reversion during July and August, at least if that's the data that stacks up here. But we are starting to see some technical reasons that could point us towards hitting these highs. And of course, inflation, FOMC, and the $1 trillion expirations coming off, along with the VIX kind of call walls coming off, could be a big deal. Let's have a look here at some of the most popular stocks. I've put them together. This is the one that's disconnected from reality at this point. And we've done this before, obviously, in other bull markets where we bounced straight back through and we moved away. But I can tell you that generally you will mean revert. And of course, as an investor, that can be an important level. Now, the reason I'm marking over here during this extreme run is because we actually moved around 18 to 20% away from mean reversion. Now, at the time of this recording, if I take the same reading and go from the high, we moved around 16% away from mean reversion. So effectively, we're getting close on one of the hottest periods in time away from mean reversion. Just put that in your mind. The hottest periods in time away from mean reversion in literally the last 3 years of trading. And we've seen some serious FOMO. We also know we're approaching these highs, and we've found these to be key before. This is probably one of the most important charts. Continue to subscribe to the channel if you're interested in that one. NASDAQ versus IWM, a little bit of a swing towards the technology stocks over the last 24 hours. We'll look at that soon. We've got the Skew continuing not to get pressed down. Skew must be pressed. I would expect Skew to get pressed after CPI or FOMC. Okay, after these events, I expect the Skew to get compressed down. But until that compresses, very difficult for the market to short. It's something that we've managed to talk about a lot. We obviously expected this bounce. We needed a turn here. We have not seen it. Some other things that have activated but not shown us a turn yet. PCC. The amount of calls in this market is extreme. I mean extreme. 700 billion, like the most amount ever, I believe, in calls. However, the PCC hasn't turned back up. Usually we can't sell until the PCC turns back up. Hasn't done it. Let's move over to the volatility. The volatility starting to spike up into the news events. No surprise. We got a TD13, but at the same time, the VIX itself is struggling to move too much. It was up off the 13.8s. This is the lowest point before the whole pandemic started. And just remember that stat we brought up a few weeks ago. We talked about the Dow Jones Transportation Index and the US 30. In 2 times, we saw a 5-day sell. Both of those times, we saw a squeeze of 9% on the S&P, then a sell-off, and around 3% on the S&P, then a sell-off. Sound familiar? Well, we've seen the squeezes so far. If that stat is going to be true, a very rare stat, by the way, of weakness in both the transportation and the Dow, then we're kind of on those levels or getting very close to them at this stage. Let's move over to breadth. Breadth has been improving, certainly one of the bull cases in this market. And if you're an investor in this market and you're feeling good, hey, I mean, you can't hate that breadth's up. That's the amount of stocks above the 200-day moving average. For the last 24 hours, a very strong close on the S&P. 43.26. I was looking for that for day traders. We'll check it out later on. We also know that the Fed have not been tapering enough and knocking off their liquidity. They're still sitting here, but we're very disconnected. And all I say to most people is this is a time to be very cautious, and I remain on that aspect. Whenever you are seeing so disconnected from central bank liquidity, you can see some of the previous times that has occurred, and you need to be cautious during these times. But it feels so wrong. You know, it feels like you've got to get in. I understand if you're in, cool. If you're running stocks, cool. But have a look at some of the disconnected from reality stocks we check out later on in this video. Q's also just running hard here. We'll talk about the key level for them a little bit later. And let's get into some individual stocks. Again, big shout out to members of the community. Last Monday, SOFI came up. I certainly thought it was a great technical entry. It was about here at the time. It's continued to bull. It's hit our first level 822. And you will see later on when we look at the options, the calls keep coming in for this stock. Are we going to a $10 read on SOFI? Probably too late to get into it now, but if you've been rolling in it, yeah, it just shows you there are plenty of percentages to be made. Here's the Monday. Here's where we are right now. That's a 30% almost increase there on the stock over a couple of days. Definitely a gambler, but certainly is still, another opportunity. Disney had an okay session, 1.32% up, kind of beat the market overall. And it continues its little rise here in fame off that move. So it's up about 3.83. It's kind of marking the S&P 500 at this point. It's still, just another opportunity that's been in those markets towards the bull side. One I noticed with some options coming into it, decent amount of overall activity going on is PayPal. Now, most people hate PayPal. Fair enough. The stock has beaten everybody down. It's one of those candidates at the moment, along with, a few others that you'll see that have been, running. Again, I think they're very risky positions. Neo's another one that's, getting a lot of interest. They are very much risk-adjusted style positions. You've got to be very, very careful here with those ones. AVGO Broadcom, big breakout here, moving back up. This is the BTFD scenario. So do I still think that AVGO's trend is over? In my opinion, yes, it would be. We're looking at these retracements. This is always the type of retracement we see. I think the party's over in this stock. However, this is exactly what you expect. The BTFD crowd to come in. Look how glorious this is. I reckon they'll be left held in the bags. But what do you think in the comments down below? This is one of the stocks that kind of alerted me to us getting close to generally kind of these hype FOMO style events. And I look at these as just statistical probabilities. If you stack the odds in your favor and you see a swing trend churn, which we don't have yet, then generally if you take the same trade or you take a very replicatable trade, August, April, these periods last year, and you'll notice that you generally are not going to be wrong that many times. You're going to win, let's say, 7 out of 10 of those times, practice the same risk management. It's just like anything, a replicatable business style strategy. And that's how the way you have to do it. Whether you're a bull, bear, or whatever you are in the markets, every trade has to be replicatable. The problem with a lot of these zero DTE style, FOMO runs is they all feel like they're great and you're a god when you're doing them or you're a superhero, but are they replicatable all the time? Can you replicate the strategy to get in? That's a big one. Defensives were not the flavor of the last 24 hours. It's just another nail in probably getting a swing trend just yet. We haven't seen defensives run a 2 to 3 day strat. That's what I'm looking for in this market to show turn. Just to remind everybody, there's a lot of 4,300 calls at stake here that were opened about a week and a half ago. So we still remain with that as a very interesting key level where options expirations, especially the June expirations, will be at stake. Let's move over to options while we're talking about it. We saw another decent day of Tesla, but it wasn't really a huge amount of relative to 90-day trade volume. There were some outliers. PBR got massive trade on it. I don't think much about that, but some interesting stocks that were doing quite well. I guess there's a huge amount of interest from retail traders in AMD trying to catch up to the NVIDIA trade. We've continued to see Adobe do really well. And then some other ones that I thought were quite interesting was actually that we continued to see Netflix do pretty good and a slowdown. Look at the slowdown here in the big tech stocks. Apple, Microsoft, have a look at these relative to 90-day trade volumes. Quite a lot lower than the rest. Also interesting to see Target continuing to be a fight zone between the bulls and the bears. But have a look at this, 59% calls, 41% puts. First time we've seen that in a while. Limited volume. I wouldn't trade the Monday either, generally with big volume, because of course you've got the risks of the inflation and the FOMC. But still, the current new thing is every time the market goes down, it's buy the dip. That seems to be the new kind of philosophy. Here's the main positions. Here are, of course, the biggest trades on the index. There were not enough puts. The puts were not the top ones. The calls were call, 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 top 3 for SPY. You can see the trade volumes. Then we got a put, then a call, then a put, then a put. For shorters, you want more puts in at least a week away, and you would rather have a ton of put volume at the top, and that to really confirm that the bigger traders are coming in on the short end. That hasn't happened yet. Let's move over to the most traded stocks. Now, this is an interesting one. PBRs everywhere. I don't know what to make of that. I'm not going to actually even look at that stock myself, but have a look at this. SOFI making it up the list. It's just been a very powerful zero DTE style trade recently. And when we scroll through, I also noticed there were a couple of other stocks starting to peek their heads up. NEO with a couple of big zero DTE options. And again, you've got a couple of puts and calls on that. And the other one that we talked about a week ago was Intel. And Intel continues to get good strike on it. Take a look at this, a 38 strike, but look at the date. Someone's playing on the Intel game, and they're going for that 40 level that we've spoken about a few times. And Intel certainly did well over the last 24 hours, one of the strongest stocks out there. There are opportunities, but of course, I think single stocks and sectors are still the better ones than indices at this point. Let's move over to the key of what's going on with target rates. Only 20% of economists believe that the rate is going up. I polled everyone on the Monday open stream, and you guys voted at 61%, I think it was, towards a rate hike of 25 basis points. So the community out there, are you smarter than economists? We'll find out very soon. That's going to be an interesting point. Let's look over rotation. Rotation across the board was all about tech and risk and everything like that coming into inflation. Is that the last hurrah? Possibly. Very little defensive plays. You can see the defensives were lackluster and terrible on the session. If we move over to the last 5 days, Jets has been one of the popular ones, which a few eagle-eyed people out there in the community did spot. We've also seen consumer discretionary remain relatively good, and actually technology has been pretty lackluster. But again, staples not really holding up over the last 5 days. They had a good 1 day kind of spurt, but then after that, just not much. Let's move over to the stock markets, of course, and we'll get into the indices in just a moment. Treasuries held that first bid day. You can see here all the hype and the scariness and stuff didn't really affect the stock or didn't affect the treasuries at all with those listings. I still think treasuries are possible to go down to this red box down here, but overall I am still positive on treasuries over the next coming years. Let's move over to the dollar index. Dollar index failed a little bit here after rallying, but it's still waiting for inflation. I don't really want to report too much on this till we see a breakout either way. It's the same thing with gold, stuck in the range. Take a look at the daily. You'll see what I mean. Stuck within a range, waiting for inflation numbers or the FOMC to break us out. Meta's another one that's interesting on the stock charts. I don't know if I trust this stock very much around these levels. It's certainly at what I would call a key zone. 75 is possible. We have no trend change yet. I'm waiting for this 258.77 to be broken below. And if that does occur, we've got a trend change towards the short end here. Just remember with the idea of recession never gets called officially until at least we get US 2-year or 3-month versus 10-year uninvert. That hasn't happened yet. We don't have a weakness in the economy yet. So the Fed still has, in my opinion, a lot of work to do. Let's move over to Tesla. 0 DTEs running this thing. We've really stated that since around these 190 levels, and it just continues to be the run. At the moment, I still think Tesla eventually goes lower, but at this stage, it's a good news story. Everyone's like, whoa, China sales and GM and everything else. There are two really distinct possibilities. The first one is a 264 gap fill, possible to happen first. And then, of course, a lot of people are going to be aiming at that 300, which is a extreme level target. And I'm not sure whether Tesla can get there when we look at the Qs in just a few moments. Apple 61.8 goes to the 75, still floating underneath the last high. No trend change on this. Still looking at potentially seeing some kind of shorting coming in on it. Haven't noticed it yet. DAX 61.8 broken back up into 75 area. At the moment, the trend's still up. As we said, we have no trend change on this particular market yet, but the trend's still up. We'll find out what happens next. Now, the Australian market's a little bit different. That looks pretty weak. So for the Australian viewers, I still think this is weak. It still looks bad. 2 rejection wicks on the trend line. It's holding on to dear life. If this thing can actually get back above these highs, which is marked around 7,300, then we might be looking at even the Australian joining in the party. But FTSE and XJO, the ASX 200, still looking weak. Let's move to the American indices. Russell 2000 still struggling with that most traded zone. For people that shorted that level, good level, by the way, they would be still okay with what's going on here in the markets, but you're probably wanting that inflation number to push it on down. Good breakout, good target zone. A lot of people are calling big moves on IWM. If you're a believer in the new bull market, certainly could be where there's some interesting kind of opportunities. But I'd probably look into the US 2000 a little bit more than just the 2000. I'd look into growth. I'd look into opportunities of the future. There's going to be a lot of companies that will suddenly become top 500 companies out of this, in my opinion, over the next decade. But as a trader, it still hasn't broken past the short zone just yet, and we'll watch that one. Now, the Qs, how high can they go? Well, firstly, I wanted to state we're super far away from mean reversion, 20 moving average on the weekly. We go back over to history of the sells and the buys, and you can see that generally speaking, you get these brutal sells that come off these hyperactive moments. Is this a hyperactive moment? I would say so with this many gaps. 1, 2, 3, 4, 5, 6, 7. I don't know if we fill that, but certainly down into here and filling these seems like a probability at some point. It's becoming the stats. We do not have a trend change. When are we going to get one? Well, as you can see here, we're starting to approach a box that I've created based on a few different things, and that is just underneath that 15,000 kind of level. So we've got 14,008 to 14,900. You can see the wicks over here. These were strong rejection zones in the past. Have we got a trend change? No, we don't. Let's look at the 2 hour. Do we have any turns here? No. We said 14,200 was a swing-based turn. We did not get a break below. It is hard to stop a freight train, and the freight train is currently still up, and you can even draw trend lines behind the freight train and all sorts of things if you want to. They probably go all the way back here as well. You can probably draw them all the way through these lows, etc. But at this stage, there's no trend change to the downside. We're approaching criticals. It's a guess more than, or a prediction more than a reaction at this point. So 14.2 still remains the swing-based turn here on these markets. And of course, the NASDAQ is not weakening just yet. We have not seen that. Let's move over to the SPX. Close on the high. Monthly R2, rare hit. That's a rare hit. So that's a pivot. Certainly strange to hit an R2 and to be able to extend away from that too much. R3s are almost unthinkable on markets unless they go into incredible FOMO. If you have a look through history, you won't see many R2 hits, and especially even more infrequently R3 hits. So that's the resistance 1, 2, and 3 dot plots that come out from the pivot. Yeah, it's pretty rare to go here. Again, just showing you how extended this market is, but notably it closed on its highs. That usually means rallies or drops should be met by rallies, at least statistically. And there's not much to say this thing is short just yet in terms of we haven't seen the turn. Level still remains 42.60 for the turn on the swing. Let's have a look at the futures market. You can see here the strength even after hours going to the 43.50. This was actually my top end scenario call. 4,300, 43.50 was pretty much where I thought we'd get to max after breaking through the 42, whatever it was, 30 zone. Yeah, the close above here, 42.20, that one there. So that moves us to the next level of equilibrium. We approach my top end base case scenario. I mean, of course, there are 4,500s as well, but this is what I would call an extreme level. And if you run a fib, so let's say we run a fib from high all the way down to the low, you'll notice we are in the golden pocket, a pretty significant resistance with all the data points that were there. Again, it's a guess. Do we have a change of trend? No. Will we in the next 24 hours? Maybe. Could we go higher? It's possible, okay? And that's the problem. You know, we cannot stop this freight train just yet. Single stocks and sectors remain some of the better positions to be in. Let's refresh maximum pain. So that is the OPEX this week. And I'm going to show down here what's going on. Obviously, the 16th, we've got a 412 max pain. So it's slowly creeping up as people close a few things. And we've got almost 5.4 million options outstanding. It is a big one. Big hedged event. Most hedged event of the year. It's going to be very difficult for this market to get any lower than probably max pain. And again, it is not a guarantee. It is a rule that if you see a swing-based trend change or some kind of trend change on the technicals, you could start to look for max pain. But don't just trade it by itself. As we know, the last two times, although it's been very good over the last couple of years, the last two times it didn't work. So yeah, you got to just remember that. 2 months, it didn't even come close to it. So this market's detached from that at the moment. Bitcoin, I still remain bearish on it to 24,000. Not much changes here in the last 24 hours. Obviously the SEC, the whole suing and whoever knows what's going on there is creating a bunch of FUD. This market most likely, I believe, needs to come down here. Head and shoulders, etc., etc. Technicals, bearish weekly, all those types of things push it to the downside. At least that's my opinion. If you enjoyed today's show, make sure to subscribe, smash that like button. Thank you so much for watching. 3 free trading cheat sheets, obviously a bunch of other stuff as well if you're interested. And I want to say a big thank you to the members of the community as well. Thank you very much for joining us. If you're interested in more stuff like this as well, join our private community, and I do a special macro show where I show a whole bunch of extra little tidbits that I think are very much worth it. Thanks so much, everybody. Bye for now.